All right, good evening, guys. Good day, good morning, good afternoon, whatever time zone you're in. This is the voice of Ken Akure. And in this section of futures trading, we want to look at how to win in futures trading, how to win in the forex in trading futures. It is said that up to 80% of people who trade speculatively, meaning who trade futures market, derivative market, forex, whatever, 80% of them lose money consistently over time, or they make money this month, lose it next month, make money this month, lose it the other month. So it's not actually a viable business. Only about 20% make money consistently over time. Now, how can you get yourself to be part of that winning 20%? In fact, out of that winning 20%, only about 5 or 10% make the big money. Others just make small pennies here and there, here and there. After a while, they just, even though they are making money, they are not making as much as they expect they should be making, so they quit the game. So how can you make yourself in the top 10% that as you start trading futures, let's say in July of 2020, in 2021, you can be trading till 2040, and you tell yourself, I've never had a losing year. I've never had a year where I didn't make profit. I've never had a month where I lost money. There will be months where maybe you are break even, but I never had a month where I lost money. I've always been making profit. So that is being a consistently profitable trader. Now, there's a certain level of thinking you must have. It is all in your mind. It is all in your thinking. It is not in the market or the strategy you use in the market, but how your mind perceives the market. So the first thing that will enable you win in futures trading is what I call defining your trading edge. Now, a trading edge is a strategy. What is your trading strategy? What is your trading plan? Now, your trading strategy doesn't tell you exactly what the market will do. It only tells you that anytime the market shows this pattern or shows this sign or shows this candle, there's a high probability it will go up instead of going down. There's a high probability to go down instead of going up. So based on that, you now create your trading edge or your trading strategy. So it is this strategy that you now create rules. You create rules that you follow. And now you have those rules on paper or on Excel or in your head. You memorize them. And anytime you want to enter a trade, those rules must be present. Now, let's look at how to create a simple trading edge. Based on the little strategy I taught you guys yesterday, using market baseline, support and resistance, recency, frequency, and market strength. Then how to use your TDI. Now let's use that and try to create a trading edge. You don't have to use this edge, but you can use a similar procedure to create your own trading edge. Now to do that, let's review the indicators that we have. Let's review our TDI. So we can now say, okay, first, in futures trading, there are only two positions you can enter. You can enter long, which is buy, or you can enter sell, which is short. Now, in defining our edge, we can say that we only take sell trades, we only go short if number one. So you write it down, number one. So let's create our for sell. So let's define our edge for sell. Let's make this smaller so that it can be in a corner. Let's put it inside a box. So let's put this in this corner. So let's create another one. So we want to define our edge now. So like I said, there are only two categories of trades you can enter. You can enter sell, which is short. Then also you can enter long. You can enter buy, which is the same thing as long, going long. So for our short trades, we'll define our rule. The first rule is that number one, let's say is price at an area of resistance. So your answer has to be yes or no. No middle ground. Is either it's at resistance or it's not at resistance. You are not thinking, you are not, oh, is this resistance? Oh, no, no. You need to be sure. Is price at resistance? Here now, price was at resistance. Then we'll create another rule. That's the first rule. The second rule is, let's look at your market baseline, which is this moving average, the brown colored one, which is your primary moving average. So you can say, is price below or above your baseline? Yeah, above the, let's call it first market baseline. Market baseline. So, and our market baseline is, let's say, 200 simple moving average. Then our answer can either be, is either below or above. So our answer can only be of the two. So no, let's ask it properly. Is TDI below? Let's put it below. So our answer can either be yes or no. Is either below it or not really below it. Or you look from the relative place where price is price coming from below it. That should be it. Is price below or coming from below? That's our second criteria for checking. Then number three, let's leave out this purple one. Let's not complicate it. So let's do number three. Number three is we'll look at our TDI. Is price at the upper, close to the upper? Is price oversold? You know, we said that in TDI, your price can either be overbought, meaning up there, or oversold, down there. So overbought is when it's around 70 and above. Oversold is when it's around 30 and below. So now is TDI oversold or around the upper Bollinger band? Then your answer is either yes or no. So with this now, we've created a rule for sell. So we've created a rule for sell, three rules. Number one, price must be at an area of resistance. Number two, price has to either be coming below our market baseline, as you can see overall, or be below it. You know, so here we can say price is below it. Why? Because it was coming from below it. So this number 2 criteria is met around here. Then here also, our RSI is, price is oversold, is overbought rather, and is close to resistance. So if we're looking at here, then it meets both conditions. Is overbought, then at the same time is around your upper Bollinger Band. So what do you have? For this sell now, you have, so if you're going to sell this market here now, and you ask these two questions, then you actually have 3/3. So you have 3/3. 3, why? Because this is yes, is priced at an area of resistance. Here, if you're going to sell here, yes, is priced below or coming below your market baseline, yes. Is TDI oversold or around a upper Bollinger Band, which was here? This sell will have been around here, which is yes. Do you understand? So you have 3/3. So 3/3, you take the trade. You now give a room and say, okay, if I have 2/3, I'll still take the trade. But that 2/3, this number 1 is compulsory. Number 1 is compulsory. Why? Because price must be at an area of resistance before I sell. So number 1 is compulsory. Then any of these other two, 1 and 2, can be interchanged, but one of them must be yes. So if you have 3/3, excellent. If you have 2/3, you still take the trade. Then you create, so if you have this now, you now create for buy. You create the same thing for buy. So to buy now, you now do the opposite. So let's scroll to where we have a buy signal. So all here now, according to your strategy, this will be sell, this will be sell. See here, this is sell. See here, this is sell. You know, this is sell. You won't be in all these buys except you come up with another edge. So you can have like 2 edge, you know, but for a start, just stick with one. Stick with one to help you trust that edge properly. So let's look out for buy. I thought this thing will follow me wherever I go. Anyway, let's look out for buy. So for buy, we are reversing these rules to favor buy. So number 1, to buy, we'll reverse the rules. Now, number 1, instead of resistance, we use support. So we'll say, is the price around or at an area of support? Then it has to be yes or no, no middle ground. Is either it's there or it's not there. Is either you see a support or you don't see a support. You can't be manufacturing support in your head. Then number 2, you ask, is price coming above or is price coming above? What did we ask here? Here we said, is price below or coming from above? Yeah. So we can switch it to, is price above or coming from above the first market baseline? So we can just copy this, then change this thing. So we ask the same question here. Is price above or coming from above the first market baseline? So then the third question is, it will be the opposite of this. Is TDI around Okay, is TDI overbought or around the upper Bollinger Band? So we write, is TDI overbought? You know, we're doing the opposite now. No, not overbought. I mix it up. This should have been oversold. This is sell, so this should be overbought rather. Is TDI overbought? Overbought is when price is around 70 and above. When it's overbought is when you are looking to short the market. When it's oversold, you are looking to buy the market. Is TDI overbought or around the upper Bollinger Band? So here now, this is correct. Is TDI oversold or around the lower Bollinger Band? Lower Bollinger Band. Answer is yes or no. Do you understand? So you now, some people now memorize these rules. They have these rules in their head. So before they take a trade, they check in their head. But the best way to do it for you is to write it on paper. So you actually tick it. That will help you build confidence in what you're doing. So for example, all here, if you are following this edge religiously, we shouldn't be buying. We should only wait, market get to a resistance. Here now, there's some form of resistance here. Wait for market to get to the resistance, sell. So that's what we should focus on. Wait for price to get here, sell. Don't try to buy. Why? Price is below your market baseline. So don't try to buy. But some people, like, if you now trade very well, after this class, we'll go into the 3 dimensions of trading, maybe tomorrow. Then some people now mix their strategy. They now have, instead of having one strategy, instead of having one edge, they now have 2. So instead of having just one strategy, they now have 2 that they use. One for following the trend, one for going against the trend. Why? Most times, market always reverse to the mean. Your mean, let's assume your mean is this market baseline. Most times, after price has gone far away from it, it tends to come back. So if you see, that's why price will always come back to these lines, these moving averages around them. It's coming back to the mean. That's how market works. That's how price movement works. So that is that. So now you have an edge. So this edge that you've created here is now serving as your guide, or the thing that you're following that will stop you from behaving anyhow in the market. Meaning it's not everything you buy, it's not everything you sell. You don't just jump into trades. You have a valid reason now for entering every trade. And because you have a valid reason, you have confidence in the trades that you enter. So you've come up with an edge. So that's how simple it is to come up with your trading edge. So we've come to the end of this session. Thank you guys for listening in and for joining. See you in the next one.